to our weekly Lunch and Learn live every Wednesday at noon. We come together and talk about strategies and how we can create wealth through real estate investing. Thank you so much for joining the live today. I'm Coach Sapphire Star, all the way from Savannah, Georgia. I would love if you guys would put in the chat or the comment section in the replay. Please tell me where you are logging in from today and where would you like to invest in your next or your first real estate investment property. This is a great opportunity for us to learn, but also an opportunity for us to connect and network and support one another on our real estate investing journey. Real estate investing, whether it's fix and flip, buy and hold, is a great way to achieve financial freedom, to be able to buy back your time and live the life that you deserve. Most real estate investors are curious in how to find deals to invest in. And if you haven't already, check out our video, which is in our Facebook group called The Gem, Creating Wealth Through Real Estate Investing. Check out that video I did on one of our lives on how to find deals to invest in. Once you find these deals, obviously you want to know, is this a profitable deal? Because that's the whole purpose of us investing, is for us to grow our money, for our money to work for us. But how do we know it's a good deal or not once we find the deal? And the answer and key to that is learning how to analyze the deal. So today we are going to talk about how to quickly analyze a rental property for cash flow. Now, there are a few metrics that we must know and understand before we analyze the property. And one of the first things that we need to do in order to analyze the property is to first, we want to evaluate our location. In real estate, if you don't know it by now, location, location, location. So be sure that you understand your market. Make sure you research market rents, market prices, the population growth, job growth, to evaluate if the location that you're hoping to invest in is a opportunity for you to make money and run your comps. We're not going to discuss running comps today, which next week I'll talk about how to run comps to get purchase market prices and get purchase rents. But just know it's very important to do what they call a comparative market analysis, or you'll hear people say running your comps before you evaluate your numbers for the deal. So I'm going to quickly share with you key metrics and things you need to gather financial information to quickly analyze a rental property to see if it's a good fit for your investing strategy. Already listed some of the four things that we need to be able to quickly analyze a property. And some of the metrics that we are going to look at today is the income, the expenses, our cash flow, our net operating income, also known as NOI, and our cash on cash return, or our return on investment on the first year of owning our invested property. For this example here, I've already gathered the information for the property. You want to make sure you have the property details and do your comps. And so here we have a 3-bedroom, 2-bath, 1,200 square foot single family home. The asking price is $200,000. We're going to assume it's going to be a 10% down payment at 6% interest. Now, one of the very first metrics that you can use to quickly evaluate income for a property is what is known as the 1% rule. And so when you're looking at a property, you want to look at the purchase price and see if you can at least rent the property for at least 1% of the asking price. So this example, if they're asking for $200,000, we want to be able to see when we're doing our comps and market research that we can get at least 1% or $2,000 a month in income. Now, the 1% rule was something that was tried and true back in the day, but it's also an archaic metric because of high interest rates and high rent prices. The 1% rule may or may not fit. However, it is a metric that you can quickly look at and evaluate to see if you want to dig a little deeper, get into the meat on the bones, as my mentor always says, to see if you want to evaluate the property and go a little bit further. So in this example, we want to think the first square that we have is the income. And the income in this example is the rent. But income is any money you have coming in to the property on a monthly basis. So this is obviously the first thing you think about is rent, but it could be any auxiliary income you may have coming in. If you charge for storage, if you charge for parking, these items go into that income block. So now let's assume for this example, our rent and our auxiliary income for this property is $2,500. A quick way to get market rent is you can go to rentometer.com. That's a free resource that you use. You can also go to real estate website like Zillow. Zillow have the Zestimate, but also keeping in mind that these numbers are not 100% accurate. So just take them with a grain of salt, but it can give you a really quick number for you to plug in to see if this is a good deal. So for this one, we have $2,500. Now we need to go to our expenses box. And this is also known as your operating expenses, or you'll hear people say your OpEx. So typical expenses that you will have for a rental property, obviously, is your taxes. Let's assume the taxes for this property is $2,500 for the year, or $208 for the month. Insurance, we're going to estimate it to be $1,200 or $100 a month. The next expense you have to consider is vacancy. Most properties are not going to be, occupied 100% occupied all year round. I mean, ideally we would love that, but that's not always the case. So we should account for vacancies in our properties. And we typically do that on a percent basis. For my property, I usually account for 5% vacancy for the property, which is, and then also too, the maintenance and repairs. These are things that you have to repair or you have to replace. Replace usually falls under CapEx, but we're just going to group these, and that's capital expenses. Capital expenses are things that are where you have to replace, like if you have to replace the roof or HVAC, you have to consider that. Most investors get into this and they run their numbers and don't consider this huge expense. And then when something happens, like the roof needs to be replaced unexpectedly or the HVAC system needs to be replaced unexpectedly, they don't account for it and it completely wipes out their cash flow. So this is something that you should set aside money every month when you're running your numbers. And we typically do about 5%. So 10% on your vacancy and your maintenance and repairs, and that's 10% of your rental income. So in this example, we're going to go with $250 for the month. Next, we have management. If you're not going to self-manage the property yourself, usually you can account for 8 to 10% of management fees. Obviously, this may vary in your area and your property type. So you definitely want to make sure that you reach out to a property manager if you're not sure, to get an idea of what management costs are. So we're just going to use 10% for this example, and that's going to give us another $250 a month. And last but not least, we're going to include utilities, and let's just roughly estimate that to be about $100 a month. Now, one of the metrics that we look for when analyzing a rental property is called net operating income. And your net operating income, or your NOI, that's your income minus your expenses. So in this example, our income for the year is $30,000. Our expenses, once we add up all of our expenses, that comes out to $908 for the month or $10,896 for the year. So we're going to subtract 10,896. My pen acting up. That's going to give us a NOI, net operating income, of $19,000, 19,100. I'm sorry, my pen is $4. That's our NOI. Next, we're going to go to the third box in this equation, and that is our cash flow. The cash flow is how much money we have left over once our income and expenses is evaluated and we subtract the debt service or the mortgage for the property. Now, NOI and cash flow may sound similar. However, the NOI is just your income and your expenses. The cash flow includes the NOI, and it is your NOI, annual NOI, minus your debt service, which in this case would be any financing that you would have. So in our example here, we have, and I've already did the numbers for to see what our mortgage service would be, but really quickly I can show you. As a real estate investor, you definitely want to make sure you have a good mortgage calculator to be able to calculate what your mortgage and interest would be. And the whole term for that mortgage and interest, as well as taxes and insurance, we call it PITI. But your mortgage and interest is, and we're going to just look this up really quickly for this example that we have, and I think I have it here, where we have the purchase price at $200,000, and the four elements you need for the mortgage calculator, and whatever three you have, you solve for one. So if you have the purchase price, down payment, the loan amount, you can figure out the interest. If you have the interest, the loan amount, down payment, you can figure out the price. So this example, we have $200,000 asking price, down payment of $20,000 or 10%, the interest rate at 6%, 30-year term, amortization. The mortgage payment is going to be $1,079.19, as you can see there for mortgage payment. So we're going to go back to our example here and show the $1,079 or $1,080. That's your mortgage payment a month. We're going to multiply that by 12 to get the annual debt service, because we're subtracting your annual net operating income from your annual debt service. So this example, we have the 19,000 from our over here. We have the 19,000 $104 minus that 1079 or 1080 times 12, that's $12,960. That's going to give us a cash flow of $6,144 for the year, or $512 for the month. As an investor, it's important that you establish and determine what's a good monthly cash flow for you to invest in a property. In this particular property, the cash flow is $512. I know for me, my minimum, I want at least $400 cash flow in a month per door. Now that's going to give us our cash flow for this example. Our last box is our cash on cash return, or our return on investment for the first year for the property. The calculation for the cash on cash return is your cash flow divided by your all-in cost. Now we know for this example, our cash flow is 6,000. Pen is acting weird. It's $6,144 for the year. Now, what is our all-in cost? We're going to divide that. Now, your all-in cost is your down payment, your closing costs, any rehab that you put into the property, that falls into your all-in cost. Now, for this property, the down payment was $20,000. Let's say we throw another $10,000 for some rehab renovations, and then our closing costs maybe at $5,000. So we're going to add that up, the $20K down payment, $5K closing costs, and $10,000 for the rehab. Let's just round that up to about $40,000. Let's just say for this example, 40K. So our cash flow divided by the 40,000, that's going to give us a 0.1567 return on investment. Now we multiply that by 100. So we multiply the number by 100, we get a 15% ROI, or cash on cash return. What does that tell us? That tells us that this investment that we put our 20,000 plus money in for the year is going to give us a 15% return on our investment. Again, as a real estate investor, it's important that you establish what your metrics are, what your minimum are. And this 15%, you have to ask yourself, can I get this anywhere else? Where can I put my money and it grow 15% in 1 year? You can't do that in the stock market. Historically, the S&P index is anywhere from 8 to 10%, even though in the last 3 or 4 years, the numbers is all over the place due to COVID. But historically, you're getting 8 to 10% return on your money. If your money is just sitting in your bank account, you may be getting 4 to 5%. You might. That's on the high end if you have a high yield interest savings account. But most bankers' account are 0.1%. If you put it under your mattress, you actually losing value in your money because inflation was what, 8%? Your money is actually losing value over time if you're not figuring out a way to grow your money. So in this example here, I'm showing you how you can quickly, and obviously the more you do this, the better you get at it, but how you can quickly analyze a deal for cash flow to see if it's a really good investment. And you can find these numbers, like I said, you can find it from a real estate agent. You can ask the seller. You can use real estate sites like Zillow and Retometer. I use a program, and those are free ways. I also use PropStream to get as much data as I possibly can on a investment property.